Right now, we're especially cautious as we're seeing great investor Ray Dalio issue a warning of potential stagflation, a very dangerous situation that could happen just as it did in the late 1970s, with high inflation and poor economic growth. This situation can't be dealt with traditionally by lowering rates, as that would stimulate growth but also skyrocket inflation. Raising rates, on the other hand, would hamper the economy even further. What we're watching here is an important relationship between prices of crude oil and 10-year Treasury yield. As you see, oil prices are good for predicting these long-term rates. However, right now they'd fail. Historically, we've seen that whenever oil prices spike, long-term rates follow. And whenever oil prices drop, for whatever the reason, long-term rates follow shortly, with a little bit of delay. What happened, however, during December of 2024 and remained up to now, is this disconnect between those yields and oil price. The WTI oil price is a major factor for the US and also global economy. This is actually the trajectory we'd more expect for the 10-year yield, as they should follow oil price. We're seeing that the bond market is no longer trading macro fundamentals. And while oil prices would have failed at predicting the 10-year Treasury yield, there is a major implication coming out of this, and it's far more interesting. This chart shows the real mystery. The long-term rates are right now sitting higher than when Fed began its rate cut in September of 2024. This is not a normal behavior. The Fed is cutting short-term rates because it thinks its policy is too tight and the economy needs space to breathe. Normally, long-term rates would fall as well. That's how easing usually works. But this time they haven't. The 10-year yield is not even sitting where it was before the cuts started, but it went upwards. That tells us something simple, and it is that investors don't buy the Fed's story. Long-term rates reflect what the bond market worries about, not what the Fed wants. And right now, the bond market is worried about US federal budget deficits, and therefore the massive US mountain of debt. There's also the factor of rising inflation. Inflation still isn't fully under control. Those concerns matter more to investors than the Fed's view of easing conditions. Monetary policy has a truly ginormous impact on our lives, especially for us investors and traders. So even though the Fed is lowering short-term rates, long-term rates aren't following because investors don't think the underlying problems have gone away. The Fed is in fact easing with these rate cuts, but the bond market is staying cautious. At Gleneus, we're always focused on providing you with superior analysis and tasty information that just make you feel great. We're seeing great investors like Ray Dalio mentioning the term stagflation. In essence, stagflation is defined as a period of poor economic growth accompanied by very high inflation. In September 2025, we saw Dalio say he fears that the current rate cut by the Fed could trigger a 1970s-style stagflation. He suggested that such a cut would likely weaken the US dollar relative to assets like gold, while long-term interest rates might actually rise. According to Dalio, if this market action occurred, it would reflect that the Fed is in a bind, stuck between fighting inflation and supporting growth, which in his view raises the stagflation risk. Stagflation is when an economy experiences high inflation and low growth, very often with rising unemployment, simultaneously, a situation traditionally seen as difficult to address with monetary policy alone. This combination is challenging as it leads to a major economic dilemma. Tightening policy to fight inflation can worsen unemployment and slow growth, while loosening policy to boost growth can fuel inflation further. This is the chart of GDP growth and inflation over the past 60 years. As you can see, we've recently hit a major inflation spike after 2021, and many fear this might lead to a similar situation to the one in the 1970s, when inflation had a similar jump and was followed by an even worse wave. This period is what many call stagflation. However, when you look closely at GDP growth and inflation, you see that yes, inflation was very high, but during this period we do not observe a crisis of poor economic growth. Gross domestic product during this time was mostly around 10% per year. This is why we think it's a major myth and misunderstanding of what actually happened. This period can't be called stagflation in the traditional sense, as economic growth was actually very strong. In fact, the only point in history that probably could have been classified as stagflation was perhaps during the early 1980s, with inflation still around 7 to 8% and GDP growth very poor, at about the 3% level. However, it's only natural to see high inflation during an amazing economic boom. If the economy is soaring and no external shocks are influencing inflation, it means consumers are spending, and therefore, companies can raise prices in response. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Gleneus.